Hi, my name is George Dagnino. I am the editor of the Peter Dac Portfolio since 1977. In this very short presentation, I would like to discuss what is the impact of the Fed and the Fed's actions, of course, on commodity prices. And by commodity prices, I mean everything from gold, crude oil, agriculturals, metals. They tend to move together. Is be aware when you see a commodity that is not behaving like all the others. Probably is going to correct pretty soon. This video was recorded in end of November 2012. And what we had at that time was a slow economy and negative real interest rates. What that means is that we have short-term interest rates below the inflation rate. This is the basic environment, and this is the environment that is driving, as of this time, the trend of commodities. By the way, all commodities. Let's see what happens. This chart shows the two lines. One is the blue line, which is the inflation rate, which is really the consumer price index over 12 months. And then the other line is the red line, is short-term interest rates, okay, from 1974 to 2012. Now, I would like to, I know it's a little on the complicated side, but it's crucial that you recognize the pattern. There are two basic patterns. There is a period from 1974, from here to 1982, this period's here, where short-term rates were below inflation. This is when people say negative real interest rates, because short-term rates less inflation is a negative number. So this is short-term rates are below the rate of inflation. Then in 1982, Paul Volcker came in and said, we got to control inflation. Inflation is 16%. We just cannot live with that. So he let interest rates go through the roof. And of course, interest rates, their normal position is to be above the inflation rate. So from 1982, as you can see, 99.9% of the times until this 2000, 2001, short-term rates, that is the red line, were above the blue line. So short-term real interest rates were positive because short-term rates were above inflation. In other words, by making short-term rates higher than, by letting short-term rates be above inflation, money is expensive, people say, because you cannot borrow, let's say, at 5% to invest at 3%. It just doesn't make sense. So people think that prices, interest rates are expensive. Now, however, beginning in 2001, we have a situation that is very similar to 1974, 1982, when short-term rates, as you can see, most of the time have been below the inflation rate. So real interest rates were negative. So what I'm saying is here we have three periods, 1974 to 1982, when short-term rates were below the rate of inflation, like from 2002 to 2012. Then there's been a long period, the great good times from 1982 through 2000, where short-term rates were above the rate of inflation, where money therefore was expensive. Now, keep these three periods in mind: 1974, 1982, 1982, 2000, and 2001 to 2012. Let's see now what is the behavior of commodity prices since 1974 based on this action of interest rates relative to inflation. This is the blue line represent the Commodity Research Bureau index of raw material prices. And of course is going up, is going down, is going up, is going down. But there is two basic trends. Commodities over the long term, they tend to rise, then they flatten, and then they rise again. Now look at when this thing happened from 1974 to 1982, commodities, the trend was up. When, you remember in the previous slide, when short-term rates were below the level of inflation. Then beginning 1982, interest rates went above the rate of inflation, so money was quote-unquote expensive. And look what happened to commodities. They were flat. Then beginning in 2001, we had the subprime crisis, the real estate crisis. The Federal Reserve lowered interest rates close to zero, and then well below inflation. And look what happens to commodities. They went up. So basically you have, when money is cheap, that is, short-term rates are below inflation, you can expect the long term of commodities to rise, like from 1974 to 1982 and from 2001 to 2012. Okay, but now you're saying, but commodities don't go straight up. Well, no, they don't. You can see these wiggles. What are these wiggles? These wiggles are business cycle induced commodity prices. If you look at business cycle, this is the time, and we'll talk about in another video, this is when the economy strengthens, commodities rise. The economy slows down, commodity declines. The economy strengthens, commodities rise. Commodities slows down, the economy slows down and commodities decline, and so on. So for instance, in 2012, commodities were weak, gold was weak, everything was weak, because we had a serious recession and then a slowdown. So again, and by the way, this trend here is the same for gold, for oil, for metals, copper. What you buy then when you buy gold or crude oil or some other commodities, really you buy volatility. You don't buy the trend. You cannot say that gold is strong and all the other commodities are weak. That's absolutely nonsense. You just buy volatility. But you have to buy gold, you have to have a view of what the overall market is going to do. Again, there is the long-term trend based on the relative position of short-term rates relative to inflation, and then there is the near-term, the cyclical behavior of commodities that instead is based on the strength and weakness of the economy. Well, I want to thank you very much for listening to this short presentation. In the next videos, I'm going to show you what is the actual action of commodities over the near term and the short term based on what I just said, and also how stock prices react to the behavior of this of what I just said about a relative position of short-term rates and inflation. Well, again, thank you very much for listening, and I hope to see you very, very soon. Take care and have a nice day. Bye-bye.